Tremendous. I'm very excited today. I have a couple of super gentlemen today to kind of get into the whole process of reverse mortgages and educating us about it. So if you guys introduce yourselves first off the bat, and then we'll get started.
Go ahead, Jeff.
Well, hi, I'm Jeff Parrott with Guaranteed Rate.
And I'm Greg Gianoplus with Guaranteed Rate. I'm the National Reverse Program Manager.
Fantastic. Absolutely. So we have a couple of slides. I'll bring them up. But the first thing I think I always start off with reverse mortgages, what you think you know about them is probably wrong. It's a completely unique kind of a world with a lot of opportunity for the right kind of person. And I'll let you guys kind of speak to that, and I'll bring up some slides for you.
I am recently trained in this program, but we figured we'd let the expert Greg walk you through the high points here.
Thank you very much. I am a certified reverse mortgage professional. I do have the privilege of leading the National Reverse Program at Guaranteed Rate in all 50 states. And I just want you to know that Jeff Parrott, our Vice President of Lending with extensive experience, he has a major team behind him to take these loans to closing and funding responsibly and with expertise. You would advance the slide, please.
Yeah, and I can speak for the quality of Jeff's work. He's amazing. So strongly endorse.
Thank you. And just as a little backdrop, just know that the stats are saying that 90% of older adults in our country want to age in place. That's probably not surprising to anybody, but people value their independence. Advance, please.
Yeah.
And here are some key motivators why people want to age in place. Again, almost half because they value their independence. Another 20% because they own their home. Their living expenses are affordable, being close and remaining close to family and friends, and just that it's an emotional attachment. Our homes are emotionally attaching to us in many cases. And we want to talk about the mass affluent today. This is a term that you may or may not be familiar with. We very much like helping in the reverse industry, the needs-based client. That's one bucket of clients over here, but there's a whole nother bucket of mass affluent clients that we'll define loosely as those that have about $500,000 to maybe $1.5 million in liquid assets outside of home equity, okay? Not your typical borrower that needs the product. So what is a reverse mortgage? It's a product primarily designed for homeowners that are 62 years of age and older to convert a portion of their home into equity or home equity into tax-free usable funds while retaining ownership of the property. Number one misconception is that the lender gets the property. It's just not the case. The most common type of reverse mortgage is the FHA insured HECM, HECM, home equity conversion mortgage. In California, folks, you do have a proprietary or portfolio product available for 55 plus.
Wow. So you can, for California, it's available 55 plus rather than 62 plus. Amazing.
The FHA insured is for 62 plus, but there is portfolio product available. The number one big concern that we hear time and again is this type of mortgage safe? And most reverse mortgages are regulated by HUD, and the US government has proactively added industry safeguards year after year, okay? Just all for the benefit of consumers. The product is very safe today, lots of consumer protections. And we won't go over these milestones. You can get this deck sent to you.
I'll share this deck with anybody who requests it. No problem.
Yeah. But please know that monthly mortgage payments are optional with reverse mortgages. People automatically think just because there is no payment, there must be some kind of catch. Okay, mortgage payments are optional. It's a growing balance loan. The interest accrues over time. Only under limited circumstances can the borrower lose their home. You have to live in the home as your primary residence, pay your property taxes, maintain your insurance, and basically maintain the home to basic safety standards. Those are your main obligations. Very hard to lose your home with a reverse mortgage. Closing costs can be higher. We'll take that offline. This is not a short-term solution. When we amortize the cost of the loan over the life of loan, the value that one gets for the flexibility is invaluable. Next, please. Yeah, this is just a simple LTV chart. Basically, it says the older one is, the greater amount you qualify for when you take out the loan. Common sense, someone who's in their early 60s qualifies for less than someone in their late 90s. It's just actuarial tables. Some basic eligibility requirements. You've got to be 62 years of age, 55 for certain programs, as we discussed. There's no minimum FICO scores. Should be a single family home, a town home. Eligible condominiums are possible. Even multifamily homes. We've got one in process right now where the borrower is occupying the property, it's getting a reverse mortgage, and the other side will have free cash flow without any mortgage payment against it. Pretty amazing.
On a multi-unit. So that's
Duplex.
amazing. So, and then it also works for somebody if they have a residence that's a second home. Like no,
No
it doesn't
second
work on
homes,
that.
no investment property. It's got to be a primary
Okay.
residence. You've got to be occupying one of the units of a multifamily as a primary residence, but you can rent out the other units on a multifamily.
Okay, perfect. Okay.
Okay, so there are different programs, just like all other mortgages. Scroll. Okay, you can get a fixed rate mortgage. I won't read this slide to you, but this example is an 82-year-old client with a $250,000 outstanding balance on an $850,000 home. The borrower wants a small amount of cash out. She wants to free up cash flows, but she does not feel comfortable with a variable rate credit line, so she opted for the fixed rate mortgage. If we could advance. And there's the $850,000 pie on the right-hand side. There's a $250,000 payoff in gold. There's the fixed rate that we closed months ago. The rates have come down just a little bit since then. She opted for $40,000 cash at closing. She qualified for more. We do not convince our clients to borrow more money than they want or need. She wanted $40,000. She didn't want any more. She got it on a fixed rate mortgage. We rolled in the closing cost. And she got a loan for $317,000 at closing, still maintaining a pretty nice equity position. Going forward, she will not make payments. She no longer has to make payments on her forward conventional mortgage, and it significantly increased her cash flow, and $40,000 was the extra liquidity that she was seeking.
Nice. Okay.
Okay. And so we also have a variable rate home equity conversion mortgage. Think of this as a line of credit. Okay. Very much like a forward HELOC. A HELOC is a home equity line of credit. Okay. In this scenario, the youngest borrower in this case is 73 years of age. The property is free and clear, $1 million property. Borrowers are looking to receive $70,000 in liquidity and proceeds, and put in place tax-free tenured monthly payments from the lender, from us. That's the old traditional style reverse mortgage where the borrower or homeowner gets tax-free payments. The payment stream is reversed. Instead of making payments to the lender is making tax-free payments to the borrower. That's why it's called a reverse mortgage. Okay, so if you advance the slide, please. Here's a depiction of this example. There's your $1 million pie. Okay, there's no mortgage to be paid off. The client chose to receive $70,000 cash funds at closing, rolled in the closing cost, roughly 3% of the value of the home in terms of transaction costs, which we itemize for people. Remember, when we amortize that cost over life of loan, the price of flexibility becomes tolerable. Okay, and so at closing, this borrower only had a $100,000 loan with $900,000 in remaining equity, and they're going to get a guaranteed payment tax-free for as long as they live in the house. It never can run out under the tenured payment option like we did for my own parents. That's $2,047 a month. It's guaranteed to never run out. On top of that, they can change it and at any time stop getting those payments and convert it all to a usable credit line if they would rather not have the monthly payments in that.
That's amazing. So, and that's if they were to be another 40 years in the house, that would be that payment every month for 40 years.
Yeah. So if you go to the next slide, there's a graphical depiction of this, and you can see on the top line is basically home value. That's appreciating at 4%. Over 20 years, the home value doubles, really over 18 years at 4%. And the bottom line represents the loan amount going up. Remember, we rolled in the closing cost, $30,000 cash at closing. They started with a $100,000 loan, and then they're getting $2,000, just a little more than $2,000 a month for all these years. We're going out 20 years. There's still a nice little net equity position. And this client is on easy street, relatively speaking, in addition to their other income. Okay, and they still have an equity position for legacy.
Amazing.
You can get a fixed rate second. It's a very niche product. We should probably take that offline given the time constraints today, but a fixed rate second is available in California, where you can keep your low rate first mortgage in place and take out a lump sum fixed rate second. It's a very interesting loan product. People are clamoring for it in other states. It's only available in 6 states, including California.
You must be doing one in North Carolina right now, because you keep on trying to say North Carolina.
Yeah. I'm based in North Carolina. Sorry.
All right, not a problem.
So we won't go over this slide given time constraints, but this is a purchase transaction that's just phenomenal. I urge you to take a look at it. This was a mass affluent client that used a reverse purchase money loan to buy a house. This is perhaps the most exciting few slides in the deck, and then we'll wrap it up. Ernie and Rose retired at 67 years of age. At the time of retirement, they had a $900,000 retirement nest egg. Their plan is to draw $50,000 a year from this portfolio. Their home is $600,000 free and clear, clearly in the mass affluent definition. The typical way that most people think, lay people and professionals alike, think of using it as a last resort. When I run out of money, I'll do the reverse. But the research shows that you should do otherwise. Instead of using it as a last resort, we think you should use it in coordination with portfolio withdrawals in a very strategic way. So if Ernie and Rose retire at 67 with $900,000 in 2002, and they take out $50,000 a year with an increase of 3.5% per year to keep up with rising inflation and costs, they run out of money by the time they're 83 or 84. If you go to the last column, you'll see once they run out of money, then they could start drawing on home equity through a reverse mortgage or some other type of mortgage. But they run out of funds at 83 years of age. If you see that third to last column, they just run out after they do their draws at $50,000 a year. Next slide, please. Okay, so instead of using it as a last resort, what we would urge customers to consider is establish a reverse credit line when you don't need it. Let that credit limit continue to rise for you, because there's a growth rate associated with that credit limit. Right now, the credit limits are doubling every 9 years. So if someone takes out a $300,000 credit line today, in say 9 or 10 years, it's $600,000. In 18 to 20 years, it's $1.2 million. It's an automatic built-in increase. It's very powerful. So you establish the credit line up front when you don't need it. You evaluate your portfolio at the end of each year. If the portfolio has gone up, take your income and draw from your portfolio. If your portfolio goes down, let the portfolio rest and take your tax-free draw from the reverse mortgage credit line. And watch the numbers and study this offline, please. It's just truly amazing. And this comes from the Journal of Financial Planning, not our industry. Next slide, please.
Amazing.
Yeah, so go back one, please.
This one?
Nope. Back. Yep.
There
Here we go. This is the slide. This is incredible, folks. It's the same Ernie and Rose scenario at 67, 900,000. Year one, they got hammered. The market was down 24%. They lost 210,000 in their portfolio. Plus, they took their $50,000 draw. Welcome to retirement. It's called sequence of return risk. After year one, their $900,000 portfolio is down to $639,000. So instead of taking your next year's draw from the portfolio like we did under the last resort scenario, they take their draw in the last column tax-free from the reverse credit line. They let that portfolio rest and recover. Instead of running out of money at age 83, 84, by using this strategy, by age 86, they still have $751,000 in their portfolio. Folks, I can't make this up. It's basic math. And what we're using as the benchmark for portfolio performance is just the simple documented S&P 500 rate of return year after year for the last 20 plus years. It's really amazing. And soon we'll be adding
an incredible strategy.
It's absolutely incredible. These folks did not run out of money. They used it as a last resort. They ran out of money by doing it in coordination with the reverse credit line. They really optimized their legacy and their funds if they need it. 1 in 4 of us are living into our 90s. Okay.
That's amazing. So that for this, you've given us some great strategies on how to use this, and knowing that as long as you live in the home, as long as you pay your taxes, and as long as you pay your insurance, and don't let the roof blow off the house, that it has to keep that kind of stuff on it. you're safe and you're good and you have multiple options with the reverse mortgage. How does a person who wants to learn more about this find you, Greg, and find you, Jeff?
Just contact Jeff, and Jeff has access to me, our entire team. To my knowledge, Guaranteed Rate is the only national lender in all 50 states that are putting tremendous resources behind our VPs of lending throughout the country so that we can take this product to market responsibly and with expertise. So just contact Jeff. He'll take care of it from there. And he has me and our team behind him, supporting him the whole way. We do not go to school on anybody in this demographic. They can't afford to make mistakes, and we will do it right.
It's tremendous. Thank you so much. I really
Greg.
appreciate you coming out and getting us educated on this today. And elevationrealestate.com for any other questions. Thank you.
Thanks, Eddie.
Been a pleasure.